Hey, what is up guys? Welcome back to ProTraderPath. I'm back with another video, and before I go to the main part, I'm really sorry about the long delay on the series of market maker model. And today is the lesson 5, so it's just the basic concept about how the gap works and where to look for what sort of blocks, for example breakout block, order block, accumulation and distribution block. Now the accumulation and distribution block, it's something that you might not heard from ICT because in his term he has redefined it a little, and I'm not going for any controversy or anything. So the person I took the mentorship from, here is a message from him so that you guys can get some idea what exactly I'm talking about. So let's hear the message first and then I'll go to the main part. Listen carefully.
Now, before we begin, you wouldn't have heard this terminology before, especially if you're familiar with ICT concepts. I coined this term many years ago when I was doing research on market maker models. Now, since then, ICT has spoken about this concept, but the terminology has never been clearly defined. Now, the reason I've called it accumulation blocks and distribution blocks is because it's specific to which side of the curve of a market maker buy or sell model we are referring to. Essentially, they are inversion levels, but when we are referring to accumulation blocks, we're talking about a raise on the left side of a market maker buy model. And when we refer to distribution blocks, we refer to a raise on the left side of a market maker sell model.
So that was the quick message from Ali Khan, whose course I'm trying to give you guys for free over here, that I bought with my own money. I found it valuable in a sense that I'm using what the ICT private mentorship students have used or have been using for their own trading. So I have the similarities, or I'm on the right path and I'm not misleading or misguiding anyone. So that's the best takeaway from this specific course that I have taken, and I hope you guys will find it valuable by the end of the entire series. Okay, so once market reaches to the higher time frame point of interest and grabs some old liquidity, it can be buy side when you're looking for a market maker sell model, or it can be sell side liquidity when you're looking for a market maker buy model. Once market reaches there, the first thing that we can anticipate to happen is a change in state of delivery. Now a change in state of delivery will occur when the highest up close candle, which is also responsible for taking the buy side liquidity, a down close candle close below with its body, right, close below the opening price of that candle. Now there are a few things that I have experienced throughout the journey. Now this is your homework, your task to keep an eye on what I'm saying right now, because this may create controversy and I hate controversies. What happens is, instead of just looking into the highest up close candle, look into the candle or candles that are responsible for taking the buy side liquidity in terms of your change in state of delivery. What do I mean by that is, instead of this candle grabbing the buy side liquidity, let's say this buy side liquidity was sitting here and it was first taken by this candle, and the very next candle was also a up close candle. So the change in state of delivery that gives me the most success or accuracy if I count by this candle. Remember, this is not a swing low that I'm showing. This is not the market structure I'm showing. I'm showing just the change in state of delivery. So keep an eye on that area and this. So the candle or candles that are responsible for taking the buy side liquidity when market closes below with a body, the opening price of that candle or candles, you can find your change in state of delivery over there. Now let's keep it simple. The highest up close candle is where you have to keep your eye on. So from here, what usually market does is it retraces back into that opening price or the lower portion of that candle, because that candle also acts as an order block. So it can retrace back there and then it starts to show the displacement. However, my preference is a change in state of delivery, a high probability order block, or a market structure shift will be valid when you will see a fair value gap is happening during that specific move. So when the market structure shift is happening, you are looking for a fair value gap on its way towards that market structure shift. Without a fair value gap, you have no market structure shift. It's not a valid market structure shift. So previously, if you have been trying to trade or trading without a fair value gap, just by seeing a big displacement or big move towards the downside or upside, now you know why your trade didn't work or market stopped you out, because without fair value there is no market structure shift. Now that part is covered, so let's move on to this part. When the market structure shift happens, since we have already discussed about the fair value gap, what else can we have a look into? Let's move from the change in state of delivery to the market structure shift. What exactly we're looking into that area. So after the market structure shift is confirmed, we can expect price to retrace back into a breaker block or into a fair value gap. Now what is a breaker block? By definition, it's a high, a low, a higher high, then market creates a lower low in the form of market structure shift or break in market structure. And according to ICT, the highest probability breaker block will form when a single move, like the manipulation leg, the last move of the manipulation leg, a single move takes liquidity from a recent swing high and a old buy side liquidity. It can be the opposite for the market maker buy model. So the highest breaker block will form or will be formed when a high probability. So let me just invert the chart for a second and let me show you what do I mean by that. So it will be the sell side liquidity in this case. So when you're looking into a market maker buy model, the highest probability breaker block will form when a single move will take liquidity from a recent swing low and a sell side liquidity in the form of an old high or old low in this case. So according to ICT, your highest probability breaker block will form around that area. Now here is the thing, my experience says the highest probability breaker block or order block has another thing in common. It will have a fair value gap within the range. So at this stage, you are looking into a breaker block. It can be the lowest down close candle, or if there is consecutive candles in the form of down close candle, for example, let's say I'm looking into this area, then both of the down close candles will be your breaker block. But this part I have drawn to show or share something else. However, so a high, a low, a higher high coming out of a higher time frame point of interest, you are anticipating a smart money reversal on a market maker sell model. When the market structure shift happens, if there is a fair value gap available that confirms your market structure shift, and the lowest down close candle on the retracement leg on the buy side curve of a market maker sell model is where you will find your breaker block. So it will have something in common, which is high, low, higher high, then a lower low will be posted and there will be your breaker block. Now often what market will do is, if there is a fair value gap aligning with your breaker block or inside of your breaker block range, you will often see that if there is any other fair value sitting above, market will either completely keep it unfilled or it will go tap the lower portion and then come lower. Now a breakaway gap, I'm coming to the gap part, but a breakaway gap can be found above a breaker block range, or if there are consecutive up close candles that can act as your order block, the breakaway gap will mostly form around that area. Now this fair value gap in this example that I'm using, this can be your breakaway gap as well, because if market doesn't fill it up completely, in this case it didn't fill it up completely, and market came below the swing low. This is a break in market structure. So first break in market structure is also called the market structure shift, and any other structure broke after that is considered as break in market structure until it reaches to that liquidity and higher time frame point of interest. So I hope that part is clear. If not, let me rewind it, or let me rephrase it one more time. The first break in market structure is known as market structure shift. It's also a form of break in market structure. Why? Previously price was creating a low, high, higher low than the previous low, then a higher high than the previous high, then again a higher low than the previous low, then again a higher high than the previous high. When this structure is broken, which is right here, when market structure shift is happening, the structure is broken. So this market structure shift is also called break of a structure. But since it's the first break of the structure, that's why we redefined or renamed it as market structure shift. After that, what is the structure now? It created a high, then a lower low than the previous low, then it created a high again, then that is lower than the previous high, then it created a low wherever the low is, then the previous low. So we are expecting maybe a retracement, something like this, a lower high, then the previous high, again a lower low, then the previous low. So this is the structure in the market. You will see most of the time this is what you are looking into. If it's not in a high impact news moment or something, because most of the time during the high impact news it gives something one-sided run for a certain moment, then it creates that structure. But most of the time, like almost every time you are looking into a market, you will find it's creating a structure on its way up or a structure on its way down. So I hope that part is clear. Now a breakaway gap, it can be a gap that is completely unfilled, or it can be a gap that is partially filled. Okay, so both gaps are breakaway gap. Once market keeps some portion open or completely unfilled and breaks below the structure and creates a new structure. So I hope the breakaway gap, this is the definition of the gap. Okay, you can expect a gap to be a breakaway gap when you have some other confluences. So in this case, let's say I have a breaker block, which is my first level of defense. I have another fair value gap aligning with the breaker block, that can be a second level of defense. So I have two level of defenses before market can reach to that gap. So that way I can expect this gap to be a breakaway gap, but there is nothing wrong for price to go there and trade into that gap. As long as there is a portion open, it will still be considered as breakaway gap when market breaks below that, when it breaks away from the area it was reaching for. Okay, I hope that part is clear again. Now again, breaker, it's very simple. As long as you are looking into the right moment and the right way of looking into a breaker block. So a breaker block or high probability breaker block will always have two things in common in their characteristics. Number one, it will take liquidity from multiple levels, in this case the way up, and it will also give you a fair value gap around that area. So when you can combine multiple PD arrays, which is premium discount arrays, together, remember almost every video I have talked about the common area. Recently I have shared my trade execution without any audio, but I was annotating or I was writing down few things that I'm expecting before it's happening, and you will see that's exactly how market did during those trade entries. If you missed it, just look for the last execution video that I have updated or uploaded on my channel. Now same thing, okay, you will see me catching almost the highest level as my entry point and almost the lowest level as my exit point. The reason behind that is, with experience, with time, I have figured out that wherever there is so many things combined together, price tends to reach until that far and then gives the move that it was supposed to give. So it works very effectively. The reason behind that is, a breaker block should act as a resistance in this case, because I'm looking into a market maker sell model. At the same time, a fair value gap has the same character. A bearish fair value gap should hold the price, act as a resistance area or zone, and send it lower. So when I have a breaker and a fair value aligning together, the highest amount of resistance that I can expect the market will have is around that common area of those things combined. And that's the reason the common area of multiple PDRs are where I'm trying to execute most of my trades, and that's the reason I have very less losing trades comparing to my winning trades. Okay, I hope you got that point. Okay, so moving on to the next stage, which is the distribution or the accumulation block. Now when we are looking into a market maker sell model, we are looking into a distribution block. Where does the distribution block forms? Usually in a market maker sell model, when the first stage of accumulation or the manipulation leg, inside of that the retracement leg, we will find our distribution block. Now ICT has defined it as the mitigation block. However, since Ali Khan claimed it pretty loudly and clearly that it's his finding, I'm going to stick with the distribution block and the accumulation block. But however you are looking into it, just the information will be the important part here. I don't want any sort of controversy or any sort of correction, because I don't need the name to look into what I'm looking for. I need the information and knowledge. They are the keys. So let's talk about the distribution block. So on the market maker sell model, on the left side, you are looking into the lowest down close candle or candles. Now if there are consecutive candles like this, both of them will be your distribution block. If there is only one down close candle that has the lowest body and in between there is a green candle or whatever color you are choosing for the up close, if there is a break between the down close candles, then you are taking only the lowest down close candles. The same way I have shared earlier, or I hope you by now you guys know what I'm trying to say over here. So yeah, the lowest down close candles will be your distribution block. What exactly happens around that area? When market is in the sell program of a market maker sell model, first market will reach below the low of the first stage of accumulation to mitigate the long positions. So people who took long positions on the leg from these areas, their stop loss will be sitting below that low, and market will take the liquidity from them, then it will retrace. Now how far can it retrace? In this case, most of the time you will find there a fair value gap around that area. That can be a possible level to retrace. Another way of retracing is the 50%, the lower 50%, which is the discounted 50%. Market can retrace the lower 50%, and the high probability or highest probability setup will form around that area, because this is where the second stage of distribution happens. And if you remember, or if you have heard ICT saying or talking about this, is if there is only one trade that he has to take or one setup he has to take for rest of his life, this is the setup he was talking about that he will take for rest of his life, which is the second stage of a market maker model. It can be the buy side, it can be the sell side, but the second stage. Now there can be more than one stages, but from the second stage it has a huge volatility. It has the power to send the market lower, and it creates the high probability because of few reasons. Now if there is a fair value gap available, you can look for a entry from that fair value. Now I will be talking about the entries in a separate video after this one, so that you guys can understand the thing. Now let me give a little bit more about the distribution block. The thing is, a distribution block and a breaker block has almost similar characteristics. Just in this case, you are not looking for a high, a low, a higher high, although it has the same thing, but you are not looking into that specific part. All you need is the lowest down close candle on that first stage of accumulation leg. So lowest down close candle with high low higher high liquidity grab market structure shift, but here you don't need the market. Like, think this way, you don't have any of these. Okay, so like this, what is that turning into? The lowest down close candles. It's also your breaker block, right? So you have high low higher high, then you have that market structure shift over here with multiple fair value gaps, however you want to take it. This is my own understanding, so yeah, I mean, don't judge me for that. I hope you got my point, what I'm trying to say here, why it turns into a high probability when there is a fair value gap available. Now in this case, market does not need to respect it the way we are expecting on a breaker block or something. So market can easily trade towards the premium end, and if you are looking for a short position from here, the best place to put our stop loss is above the distribution leg high. So maybe a tick above or something. If the fair value, if it covers the fair value gap, especially the candle that created fair value gap, if it covers that, you can put there. Now in this case, look, the third candle is here, second candle is here. Yes, you can go for the third candle, which is a better option since the distribution block high is there, so you can put at the third candle. Now if it was only a single candle with a distribution block, the stop loss could have been like, let's say this is the distribution block, this is your fair value, a better stop loss could have been this candle, okay, that high. Now this is solely depending on how you are looking into a trade and how you feel comfortable keeping your stop loss or putting your stop loss, because for me, I want to be stopped out of the market from where I'm wrong. For example, if I'm taking a entry from this fair value and that's the third candle of the fair value, I will put it above the third candle. The only reason behind that is 3 candle creates the fair value gap. I'm happy to be stopped out above that level, because if I'm wrong about my fair value, I want to be wrong the candles that created the fair value. I want to be wrong at the point from the candle that created the fair value. I don't need to put my stop loss above the swing high or a swing low, something like that. The reason behind that, yes, sometimes what I saw, it created equal highs or came very close to that level, then it actually delivered. But as I said, if I'm wrong regarding the fair value, I want to be wrong here. I don't want to be wrong there. Okay, that's the reason I said it's solely depending on how you are comfortable. I'm comfortable putting the stop loss wherever I think it should be. If this is something I'm expecting as a breakaway gap, and let's say I'm taking a sell short from that fair value, the only thing I will cover is the candle that has the gap. So let's say like this candle, this is the high, so let's say the high is here. I'm not putting my stop loss here and saying like, okay, this fair value has to deliver the sell side delivery or something. I'm not putting there at the high. The reason behind that is, if I'm wrong regarding my fair value gap selection, I have a breaker block, which is first level of defense. I have a fair value gap aligning with my breaker block, which is second level of defense. I have a breakaway gap possible breakaway gap or a gap that may work as a breakaway gap, which can be my third level of defense. Now I'm not looking for order block mean threshold, or I'm not looking for the swing high as the fourth and fifth level of defense. I'm looking at that gap as my entry. Since there is another fair value, yes, I can let the market trade until even the upper half of that fair value, because I'm expecting a little portion will be unfilled. So I'm happy to put my stop loss there. If I'm wrong here about this, I'm wrong about that, then it will stop me out. If there is only one gap, I will put the third candle's high above that as my stop loss, because I'm depending on this fair value gap, the candles that are responsible for creating the fair value. If I'm wrong regarding my fair value gap selection, I want to be wrong here. So this much of the money I don't need to put in my market, because ICT said if a market breaks below or above 3 levels of defenses, then the next target will be your back. Okay, I'm just keeping it in a polite way, but it was even harsh. So I hope you got the point. The next target for the market is your back. So yeah, I don't want to be putting my back over here so that it can come and push the bullet inside of my back. I'm happy to be stopped out here. I hope you got my point. So yeah, I mean distribution block. Now the vice versa is truth for the accumulation block, which is on a market maker buy model. So if I just invert it on a market maker buy model, the first stage of manipulation or the accumulation leg, you will find a fair value gap around that area, and those highest up close candles with the body will be your accumulation block. So I was showing the distribution block, the highest up close. So just invert these green colors into black and black into green. Since it's a drawing and it will be a very long video if I go to do that, but I hope you are getting it. So it's just the vice versa, highest up close as your accumulation block on a market maker buy model, and highest down close as your distribution block on a market maker sell model. And so far I have covered a lot of things. I hope that part is clear. Now about the gaps and stuff, you already know what I have shared here, like a breakaway gap, a fair value gap. Where can you expect, why can you expect? Because before reaching to the gap, if you have some level of defenses, that is where you can expect a certain thing. So your expectation has to have some sort of validity. The validity here is, for example, if I'm expecting this to act as a breakaway gap, I need some reason for market not to reach there. So that gap will act as a breakaway gap when I have some reason. I can expect only when I have some reason. Where is the reason? I have a breaker block. Okay, if the breaker block is violated, I have a fair value gap. Now I have 2 level of defenses that was somehow, let's say, it's violated. So this gap, I'm expecting that market, even if market comes, it will tap the lower portion or even trade into the lower half of the gap, then it will continue lower or deliver to the side that I'm expecting. Now if I'm wrong about that gap, as I said, I'm happy to be stopped out right above that gap. As long as it keeps some portion open, it will not stop me out. And since that is what I'm expecting and my expectation was not correct, I'm happy to get stopped out over there. Whatever loss it gives me, I'm happy to take that loss. I will wait until I find a better setup to enter into another trade to mitigate the loss or to get some profit. Things like that. Okay, I hope my points are clear. And with this lesson, I have almost covered everything. Now the next lesson will be the entries and the time of the delivery, that you can expect certain things or you can look for certain things on your chart. So until next time, take a very good care of yourself, your health and your loved one, and bye bye.